Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
The financial event that unfolded on December 23, 2025, involving Highway Holdings Limited, that's NASDAQ, HIHO, it really represents one of the clearest conflicts between deep fundamental valuation and chaotic market microstructure that we've seen in years. In just that single session, this microcap stock surged more than 50% from its open. But the number that really defines the day is the trading volume, reportedly exceeding 158 million shares traded.
And that 158 million figure is, I think, the crucial anchor for our entire discussion. Just to offer some context here, HIHO's entire publicly available flow is approximately 2.8 million shares. So this means the stock turned over more than 50 times in a single day. It completely annihilated its typical daily volume of just, 15,000 shares? The sheer unprecedented scale of this churn forces us to look beyond the price jump and ask a fundamental question. Was this repricing a rational, informed correction reflecting a legitimate strategic shift? Or was it primarily a chaotic liquidity anomaly driven by algorithmic volatility, masking some really significant execution risks?
I hold the firm view that this volatility, however extreme it looks on the surface, was fundamentally driven by a long overdue rational correction. The market, well, it finally woke up to a severe and frankly a bizarre mispricing. This company was a deep value play, trading below its net cash position. It was a classic net-net situation, and the corporate news just provided the perfect catalyst to close that gap. I maintain the stock's move reflects a necessary validation of inherent balance sheet strength and a highly strategic pivot.
And I'm going to argue that while the underlying corporate news is significant, yes, the volatility and that volume figure skew the interpretation entirely. The magnitude of a 158 million share surge suggests the price action was dominated by high-frequency trading exploiting a low-flow, low liquidity environment, and that results in unstable price discovery. This outcome is a classic market mirage. The current price fundamentally ignores the high, maybe even insurmountable, execution risks management has now taken on.
Well, let's look at the numbers before the news broke. My core thesis is really anchored to the balance sheet integrity. Prior to this event, HIHO held approximately $5.3 million in cash. That equates to roughly $1.20 per share. Yet the stock was trading as low as 83 cents. This is essential to grasp. The market was essentially assigning a negative valuation of 37 cents per share to the entire manufacturing operation. You were in effect getting paid to own the company's factory, its IP, and its customer base. That is textbook market irrationality.
It is irrational, I agree, but we have to understand why the market was so depressed. It wasn't because the market was blind to the cash, it was because the operating business was hemorrhaging.
And that brings us to the catalyst, the letter of intent to acquire a 51% stake in Regent, Feinbau, Adderman, GmbH. This is a German manufacturer specializing in high-precision components. And crucially, this acquisition comes with the IATF 6949 certification. That's the global quality management standard required for automotive suppliers. This strategic pivot provided investors with a free option on growth. The correction was justified because management is pivoting to import German technology to penetrate the enormous Chinese domestic automotive market, reversing that existential decline caused by the Czechia shift.
We need to slow down and define that Czechia shift because I think it's the key to understanding the company's desperate situation. What you're calling a savvy pivot, I would call a high-stakes emergency response. The Czechia shift was a structural supply chain movement where major automotive OEMs nearshored production from Asia back to Eastern Europe, places like the Czech Republic. This is what wiped out HIHO's legacy motor export business and created the crisis in the first place.
Exactly. They were structurally broken, and they needed a radical fix.
But the fix itself carries massive immediate downside. While I concede the net-net status created a powerful theoretical floor, the magnitude of the value, that 158 million shares, fundamentally suggests the price action was driven by HFT algorithms rather than stable, informed, fundamental buying. More critically, that strategic pivot you champion is a response to an existential crisis. The Q2 2026 results showed net sales had plummeted to $1.18 million, resulting in a net loss of $373,000. They were on an accelerated path toward insolvency. And now the acquisition uses a majority of that $5.3 million cash cushion. The safety net is gone, drastically shortening the cash runway if this new, highly complex German-Chinese strategy fails to integrate or quickly turn profitable. The post-news valuation is now premised on betting the company on a risky, capital-intensive move.
I see the appeal of focusing on the mechanical chaos of the trading day. I do. After all, 50 times the float turnover is jarring, but the data points away from the type of speculative manipulation that usually causes these bubbles. Let's actually look at the details. Short interest is negligible, just 0.49% of the float. There was no short squeeze fueling this. Moreover, detailed dark pool analysis shows off-exchange volumes were infinitesimal. I mean, we saw days in December with reported dark pool volume of only 8 shares. This was not institutional suppression suddenly reversed. This was fresh long buying, correcting a valuation gap that was truly bizarre. The volume spike merely reflects intense churning by market makers struggling to match demand in an illiquid name after the news fundamentally changed the narrative. The volume is an effect of the news, not the cause of the repricing.
That's an interesting perspective, trying to rationalize extreme churn as mere market plumbing. But I frame it very differently. Extreme turnover, 50 times the float, is the very definition of instability and chaos. When market makers are struggling to find shares, the price discovery process itself is unreliable. It means the price movement is based on instantaneous, high-frequency volatility, not long-term holder conviction. We see this in microcap spikes all the time. And the lack of traditional speculative involvement, from the retail communities who thrive on optionality, is actually a warning sign. The absence of an options chain and the small market cap mean there is no stable distributed retail base to support this price level. This leaves the stock incredibly vulnerable to a rapid reversal once that immediate liquidity void is filled or, crucially, when the algorithms decide to harvest their arbitrage gains. You're arguing the foundation is strong, but the building was erected on a high-speed trading platform.
But that assumes that the fundamental shift in strategy is worthless, which simply isn't the case. Let's shift the discussion back to the credibility of the pivot itself, because the technical setup wouldn't matter if the strategy wasn't profoundly sound. Management was facing the collapse of the legacy motor export business due to the Czechia shift. Their reaction is a highly sophisticated, calculated pivot toward the import capability to China model. They identified their problem. They couldn't meet the standards required by high-end OEMs operating in China.
And the solution is?
Regent Feinbau. Their technical capabilities, precision sheet metal manufacturing, and their IATF 1699 certification are the keys. This certification is mandatory for supplying components to global German automotive giants like VW, Mercedes, and Audi. Acquiring this capability instantly unlocks the estimated $50 billion Chinese component addressable market. They are directly targeting German OEMs manufacturing in China, who demand those exact high German standards that HIHO could not meet before. This is not a random diversification. This is surgically addressing their biggest failure point with a best-in-class, established German brand.
I'm just not convinced by that line of reasoning because it minimizes the colossal execution risk inherent in this transition. We are talking about a company with a negative long-term track record. Their compound annual growth rate over the last 29 years is negative. Now this deeply troubled management team is attempting a challenging technology transfer, integrating a specialized 1949-founded German entity into its existing loss-making Shenzhen footprint. That is a massive operational leap. Management is shifting from a predictable harvest mode, where they at least provided a high dividend yield, to a capital-intensive growth mode with virtually no cash cushion remaining after the deal closes. The historical evidence suggests extreme caution, and the change in strategy multiplies the operational risk dramatically. You're essentially betting that a historically failing management team can execute a flawless, highly specialized international integration project.
You're focusing on the past, which was dictated by global supply chain forces beyond their immediate control. They were a victim of nearshoring. They are now taking control of their future.
And even acknowledging the historical performance issues, the valuation argument remains the strongest defense against your risk profile. Even after the surge to $1.34, the market is assigning only about a 14-cent per share premium over that original $1.20 cash floor.
That's a fundamentally flawed calculation now.
Hold on. That 14-cent premium values the entire legacy operating business plus the new German growth opportunity at roughly $640,000. If we're talking about unlocking a $50 billion component market using high-value German certifications, valuing the enabling business and the legacy operations at less than $750,000 is still deeply discounted. If the Regent Feinbau acquisition is even moderately successful and accretive, the upside potential is massive, secured by the fact that you effectively bought the underlying assets at barely above their cash price.
That's a compelling argument, but have you considered the nature of the cash floor now? You cannot continue to rely on the $1.20 floor when management has publicly stated they are using a majority of that cash to fund a high-risk acquisition. The cash floor is being dismantled to fund a risky future. That 14-cent premium is applied against a company that posted a $373,000 net loss last quarter. That implies a rapid cash burn rate that is now exacerbated by integration costs. The market is ignoring the immediate risk that the company burns through its remaining diminished cash faster than it realizes synergies from the German acquisition. This isn't a safe net anymore. It's a deep restructuring, and the primary risk is a severe liquidity crunch and the need for immediate dilutive capital raises if execution fails.
I'd argue the pivot directly addresses the burn rate issue by replacing the collapsing low-margin European export revenue with what should be higher-margin, specialized Chinese domestic revenue. The negative figures you cite are reflective of the old business dying, not the new direction failing. The valuation gives management enormous leeway. They only need marginal success to validate the current price.
But the acquisition costs are immediate, guaranteed, and certain. The synergies, the technology transfer, and the new contracts are distant, uncertain, and historically challenged by this management team. Investors must rigorously price in the failure risk of that technology transfer. We saw the stock spike 50% on news, but the fundamental challenge remains execution in the face of dwindling resources.
It is a calculated, aggressive, and necessary risk rooted in correcting a balance sheet anomaly and addressing a market failure. It's the only pathway forward.
And that pathway forward was illuminated by chaotic volume that obscures the underlying financial fragility and the immediate operational instability. The volume is the noise, and the execution risk is the signal.
But the signal is a multi-billion-dollar addressable market.
With a 3-decade negative track record.
So our discussion has really centered intensely on whether the dramatic price action in Highway Holdings on December 23rd, that 50% surge on extreme volume, was a rational recognition of the deep cash floor and the necessary strategic pivot toward the German acquisition, or if it was predominantly a chaotic, liquidity-driven market event that fails to properly discount the significant execution risks and immediate operational struggles, specifically those Q2 losses.
Right. I think we agree that the core conflict lies squarely between the undeniable theoretical strength of the balance sheet, which provided the anchor for that initial price correction, and the perilous state of the income statement, coupled with the massive complex operational leap required to successfully integrate the specialized German firm into the Chinese strategy.
The fact remains that the compelling net-net status, coupled with a highly strategic and well-aimed pivot toward the robust, high-standard Chinese domestic market using high-value German engineering, makes this a clear, special situation opportunity. I maintain this move is rooted in fundamental value and strategy rather than purely temporary speculative hype, a view that's supported by the lack of retail or short squeeze involvement.
Conversely, the extreme volatility of the surge and the 50 times turnover ratio suggest a market highly susceptible to algorithm-driven chaos. I think investors must recognize the precarious financial position, the rapid burn rate, and the substantial execution risk associated with using the majority of the company's capital on a complete systemic strategic overhaul. The safety net is gone, and the future relies entirely on managerial prowess they have yet to demonstrate.
The situation presents a fascinating high-stakes conflict between the hard numbers of the cash floor and the difficult realities of corporate turnaround strategy.
The ultimate value of HIHO depends entirely on management's ability to successfully execute what is effectively the China bridge. It is an investment that requires an aggressive belief in their future capabilities, not their past performance. This story of survival is far from concluded.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.